Inflation is the monster that is creating havoc in the stock market these days. So let's explore how it affects us all and is there a way to inflation proof your portfolio? Hi, my name is Sunny and I make videos that affect a common man financially. If you're new to this channel, please subscribe to it alongside smashing that like button as that will help me with the YouTube algorithm, which will be highly appreciated. By definition, inflation is the rate at which value of a currency falls, which brings a decline in its purchasing power over a period of time, whereas you see a general increase in prices of goods and services that we consume. The most commonly used inflation indicator is Consumer Price Index or CPI, which is a basket of goods and services that we use in our day-to-day lives. Since we need lot of goods and services, therefore loss in the currency's value where buyers can buy fewer goods or services for the similar dollar value is a typical example of inflation. A cup of coffee that you can buy today for $60 used to cost a quarter in 1970. This is what inflation does to prices. Inflation in the US is around 7% these days, whereas the Fed has the mandate to check inflation and keep it around 2% either by increasing or decreasing the money supply in the system. Hence, the Fed has to raise interest rates this time to bring down the inflation levels, which we all know has got a negative effect on the stock market and people's portfolio. Now we know inflation affects our budgets and reduces the purchasing power of money in our pockets. Therefore, the next logical question is to ask, is there a way you can inflation proof your portfolio so that your returns are at least equal to that of inflation, if not less? As an example, if inflation today is around 7% in the US, you need to build a portfolio where you at least get 7% so that you can retain the value of money. Investing in stocks generally is considered as the best hedge against inflation because with inflationary pressures on other asset classes, this also appreciates proportionately. Now about inflation proof strategies. There are broadly three ways that I think you can inflation proof your portfolio, which are as follows. Number one, TIPS funds. As the name suggests, these are called Treasury Inflation Protection Securities. You can buy mutual funds or an ETF that invest in these TIPS, where the idea is to help you prevent against eroding your wealth against rising prices or inflation. The fact remains that TIPS are not an ideal candidate for inflation proofing for every investor or situation because in certain cases there are other factors that can negatively impact the returns they offer. But people close to retirement in certain cases choose these funds because its value generally is less volatile than other asset classes like stocks, commodities against inflation. In my opinion, this is a workable strategy only for a select few investors. Number two, bank stocks. During inflation times or when the interest rates are increasing, usually bank stocks give you better returns because they are in the business of lending. Basically, banks make money based on the spread between the rate at which they borrow and lend. Now, during the times of increasing interest rates, they can charge more interest rates while lending, therefore, make a lot more, which is reflected in their appreciating stock price. Hence, you can either research and buy individual bank stocks for better returns with more risk, or for a more laid back passive investing, buying a low cost bank ETF could be worth considering, where the returns might be less, but that lowers the risk too. Number three, dividend ETFs. This, I think, can be the third important pillar of investing during inflationary times for protecting your portfolio. Usually, its composition is a group of high dividend paying stocks which have a proven track record of growing dividends for at least 10 years continuously. A perfect example of it could be Microsoft or Coca Cola or Procter and Gamble, which are mature, slow growing businesses with huge moat in place that comes with the ability to rise prices during inflation. ETFs comprising of such companies often are considered as one of the best low cost investment strategies while being good for passive investors too. In such a case, you don't need a lot of time along with expertise for researching individual stocks, which often comes with possibly more returns but definitely larger risks. Generally, they give you passive returns in the form of dividends, whereas underlying asset also appreciates over a period of time. At the end, I believe there is no one fits all strategy when it comes to inflation proofing your stock portfolio. It all depends upon your risk profile and having a combination of different investing options that can do the trick. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation. This is my take on the topic, inflation proofing how. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.